Good evening, everyone, and welcome to this Nadex Crash Course on how to trade volatility and then examining volatility with our emerging market trends, current emerging market trends. I want to welcome everyone. Thank you so much for joining us this evening. We got quite a crowd, and this promises to be hopefully engaging and interactive. So my name is Todd Rich. I'm with Nadex. The presenter who's going to kick us off is going to be Chris Vecchio, one of my esteemed colleagues from DailyFX, one of our affiliated companies here at IG. And Chris is going to take you through what is volatility. He's going to define it for you. We might actually, I might pop some questions into him as he goes to keep him on his toes. But we are going to discuss volatility. What is it? How is it measured? How do you analyze volatility in the markets? And then, as I mentioned, we're going to turn this into a practical demonstration. As I like to say, my mom is from the great state of Missouri, or if I pronounce it right, Missouri, the show me state, and we want to show you. So then we're going to show you how you could potentially take advantage of these opportunities when you understand volatility and how you could potentially leverage that as opportunities in the market. And particularly at Nadex. And I am going to talk about the Nadex products. I will spend just a few minutes talking about Nadex binary options, and then we're going to go to the charts. That's where we're going to have some fun. We're going to pick Chris's brain. We're going to talk about his opinion and what he's seeing on volatility, both short term and maybe even medium term a bit. And we're going to have some fun. Now, some housekeeping items before I flip it over to Chris. Number one, on the right-hand side of your screen, you see a little question mark. It might even have a 1 in it. If you click on that, that is the questions panel. This is interactive, as I mentioned. If you've got questions, please type them in. I will interrupt Chris if it's appropriate and try to punch them in to make sure that he's being clear on what he discusses. And then I will tell you when we jump over to the more practical demonstration, what I call the off-roading demonstration, if there's things that you'd like us to discuss or examine or take a peek at, you'll have to let us know, and we'll take a look, whether it's one of the commodities markets like energies or precious metals, or whether it's in the foreign exchange market or even in the equity indices markets. I know Chris is going to be discussing all of those when he discusses what is volatility, how is it measured, and how you take a look at that in the marketplace. So there's my housekeeping items. Oh, one more housekeeping item, and this is important. Up top, this is being recorded. Repeat, this is being recorded. And if you'll be able to review, because you've registered, you'll be able to go back and review this, or you can share it with your friends afterwards. The recording will be available on the Nadex YouTube channel. I would recommend that you go there and subscribe. It'll also be available on our website. And if you registered, you'll get an email notifying you where you can locate it. The other thing I'm going to mention, if you would like a copy of the slide deck, I will tell you how to get that in the middle. So I'm just teasing that out there so that you stick around and listen to what Chris has to say about volatility, and then I'll tell you how you get that slide deck if you would like it. So with that, I would like to turn it over to, because we are here for about an hour and a half, if we go all that time, but I would like to turn it over to Chris Vecchio from DailyFX. Chris, welcome, and I'm going to let you run with it for a bit.
Todd, thanks so much. Hi, everyone. Good evening. Hope everyone is having a good day so far. If you are joining us on the high holiday, thank you so much for your time. Hopefully you break fast sometime soon. Otherwise, I'd like to say welcome to the Nadex Crash Course on how to trade volatility with emerging market trends. As Todd said, my name is Christopher Vecchio. I'm a CFA charter holder. I'm a senior strategist with DailyFX provided by IG Group. Just a little background on myself before we go into the various risk disclosures so quickly. I've been with DailyFX since I was an intern back in 2008. I made my way up through the ranks, required by IG in 2016, been a sister company of Nadex ever since then. It's been a pleasure to work alongside Todd and others. What is my background? I have 2 degrees in political science and macroeconomics. I've been a CFA charter holder since 2017. I've lectured at Duke Law School on derivatives trading, so I've done a little bit of everything here. Before we go into the presentation, of course, however, there are a few little boxes that we have to check off here, and those being the ever important risk disclaimers. As always, any opinion that you hear from myself is mine and mine alone. It does not constitute trade advice on behalf of DailyFX, IG Group, Nadex, or even Todd himself, although I do think we share a few similar opinions. If you do have any comments or questions over the course of this presentation, feel free to put them in the chat box on the right-hand side of your screen. Todd will be feeding them through over the course of the session, and we will be wrapping up with a Q&A at the end. So if we do miss your question, feel free to re-enter it into the chat box so that we can have this discussion. We want to be able to provide information and feedback to you and hopefully curate an ongoing conversation, not just today, but moving forward in the future, should you have any questions about trading. So the first thing first here, what are we talking about? We're talking about volatility. Why are we talking about volatility? Well, we're not talking about necessarily the direction of price changes. We're talking about the future stability of a financial asset's value. So instead of necessarily trading on a price either rising or falling, we're trying to examine whether or not a given asset will have movement. We'll see movement in the future. So volatility itself is a bit agnostic. When we take a look at a given measure of volatility, we're going to cover three here in particular: stock volatility, oil volatility, and gold volatility. We're not necessarily predicting which way things will move, although there have been historical relationships between price movement and shifts in the volatility indices. Now, why look at volatility itself? Because volatility trading and examining measures of volatility can be particularly valuable when there are either domestic events or global events that are driving markets to move erratically, move in ways that you may find unpredictable. So if you're expecting a significant market reaction, but you're unsure which way it will go, volatility trading and using volatility measures to inform your trading, it helps you take a better informed position. And if you are using this information correctly, it may help you have a better outcome than you would have had otherwise. Now, when we talk about volatility, the three main indexes that we're going to be looking at here today are the VIX for stock index volatility in the S&P 500. We're going to be looking at GVZ, which is gold volatility, and we'll be taking a look at OVX, which is oil volatility here. Now, starting things off, talking about VIX, which is the most popular, most widely known measure of volatility. When you go on TV, when you look at CNBC or Bloomberg or Cheddar, and you see them talking about volatility in the market, they're most frequently referring to the VIX. So what is the VIX? What is this thing that you keep hearing about? Well, the VIX was invented in the 1990s, and it's a measure put forth by the CBOE, the Chicago Board Options Exchange. And it was the first benchmark created to quantify market expectations of volatility. Now, it's important to know that this is not just like looking at a ticker for, say, a stock like Apple or natural gas or even Eurodollar. We're only looking at the implied volatility of the S&P 500 for the next 30 days. So that's actually a very important point, because this is not a normal chart or a normal graph that you're looking at. You can't perform your typical technical analysis on VIX or GVZ or OVX because these are non-standard time series. We're only talking about the next 30 days, while when you look at, say, a ticker of Apple or natural gas, we're basically looking at what all future expectations are for cash flows for next year and the year after that and all the quarters in between, distilled into today's price. And that's why we have things called discounted cash flow models. And that's in part where the value of stocks are derived from. But when we look at the VIX, we're only talking about the implied volatility of the S&P 500 over the next 30 days. Now, as you see on my screen, the VIX is calculated using the prices of S&P 500 index options, and it is expressed as a percentage. If we see the value of VIX increasing, it's likely that the S&P 500 is falling. And if the VIX is declining in value, then the S&P 500 is either proving stable or perhaps going to rise. This inherently makes a lot of sense, right? If you're talking about uncertainty in the near term, how is a stock's value defined? How is a bond's value defined? Well, we're talking about cash flows. We're talking about earnings. We're talking about dividends, coupon payments. We're talking about certainty over which way the money's flowing. So if volatility is increasing for a given asset class, it potentially means that there's greater uncertainty about the underlying fundamentals of said asset class. Now, while the VIX only measures S&P 500 volatility, it is commonly used as a benchmark for all US stocks. The price of options is considered a good measurement of volatility, as if something concerns the market, traders, short-term, long-term, or even investors, they tend to start buying options. And this, in fact, can cause price to rise. When option dealers sell calls, for example, they're forced to buy some of the underlying asset for which they are issuing this option, they are underwriting this option, and this provokes what's known as a delta hedging. Now, this seems complicated. It's not really at the heart of what we want to discuss here today, but the point is that when options volume increases, when call options volume increases in particular, you tend to see the price of the S&P 500 go up. So why do we care about this? Well, it's not tracking the stock market itself. We're talking about the underlying price of S&P 500 options. And these options contracts, they do take their prices from the S&P 500, which is a capitalization weighted index of 500 stocks in the US. Now, options, they give a trader the right, but not the obligation to trade the S&P 500 at a set price before a set date of expiry. And actually, Todd, this coming Friday, we have a big options expiry coming up.
Yeah, I was about to mention that, because tomorrow we've got options expiring across multiple asset classes, right? We've got the ETFs, we've got the futures, we've got all of it. It's a buzzword. I'll save the buzzword for you.
Well, it's quad witching, as it's known. And quad witching, which is a really, interesting term, it's the day that stock index futures, stock index options, stock options, and single stock futures expire simultaneously. Although, Todd, I don't know if there's much volume around single stock futures. That seems to be more or less
there is a lot. It depends on the stock. There's something I wanted to ask you about, because you mentioned something really important. And it's when there are more buyers of these options, and they could be buying calls, or they could be buying puts. Interestingly enough, and we don't need to go into options theory, but clearly when there's more buyers than sellers, the price goes up, right? That's just a natural supply and demand. That's those options that are costing more money. That is the increase in the premium levels that people are prepared to pay for these options. And the reason that people, and there was a particular word that they call the VIX, and you hear about the VIX often referred to this in trying to measure volatility, it's the fear index. It's when people would rather own the options than the underlying asset, or they're looking to make a play on a large move, whether the move is up or down, particularly to the downside, as you mentioned, when there's a concern that prices are going to drop. Options actually can be considered a form of insurance in certain regards, in which case, yeah, the premium levels are going to go up because people are fearing some type of negative event. So the fear index and the VIX going up when prices go down, there's definitely a relationship there. So I think people need to understand that watching VIX is important, because it does give you a sense of how people in the market are voting with their money on a potentially disruptive event.
Right, and even when the VIX goes up, Todd, I mean, it's not necessary that the market goes down for a prolonged period of time. It could be something like a short-term hedge. Just over the long haul, we see that stocks tend to have an upward drift. And since World War II, stocks have returned about 8% per year with a 13% standard deviation. In the QE era, that's been a bit higher, around 12% annualized returns. But if you are someone who think that your individual company has sufficient positive long-term prospects, you are concerned that there is some issue on the near-term horizon, you may find yourself going into the options market, looking at things like either plain vanilla options or even something like binaries, so that you are effectively insulating the total value of your portfolio. So yes, if volatility does rise and the individual prices of the assets that you own go down, you at least are able to have a trade-off there, where the gains that
You're
you have in your
protected.
volatility. Yes, you're protected.
You're right. You're protected a bit, or and that's, you can either offset it by hedging, or you could just simply go entirely to options. Because if you buy an option, uh, whether it's a binary option or whether it's a standardized equity option, you can't lose any more than what you paid for it. So binary options, I mean, you've got absolute limited risk. You can take an opinion, you can maintain your long bias, or you can actually take a short bias, but you know that if you're wrong, you're not going to get blown out. And so people will, they'll do a trade-off. They'll do a risk assessment. Would I rather own the actual underlying, or would I rather limit some of my risks and pay a bit of a premium in the term in volatility, so that I do know that my downside is protected, whether I'm going long or short. I can't blow up everything. Well, you could if you put everything on it, but the equivalent, there would be no surprises. You knew what you were getting into before you did the trade.
Absolutely. And that's a really important point to make. And I think it actually speaks to some of what was going on we saw during the height of the pandemic. If it was, mid-year last year or even earlier this year around GameStop and AMC, where people were taking perhaps even some of the money they were receiving in unemployment benefits. There were some studies out there that suggested around 20% of the money or funds that were distributed as a result of unemployment benefits were making their way back into the market vis-a-vis options, because you
Right.
could take $100, $200, you could put it down. That was the capped loss you had, because if your option expired below its strike, it was worthless. But they were effectively lotto tickets for some people. And so these options, they give you the right but not the obligation. If you're buying a call, it gives you the right to buy the S&P 500 at a specific price, while a put could give you the right to sell the S&P 500 at a specific price. And that specific price is what we call the strike price, Todd. And I think a lot of people were using the options market as a way to effectively, I don't want to say gamble, but they were doing so in a manner that was, what's the term they used today? The kids use YOLOing.
Yeah.
They were trying to.
So yeah, it is rather interesting. Well, let's keep cruising. Oh my God, this is always fun. I love this one.
Well, this is the great Greek formula that they forced us to learn when we were studying for the CFA chart. It was in level 2 and level 3. And quite frankly, I'm only showing this on the screen so that people can have a conceptualization of what's happening. The calculation of the VIX, involves some complex mathematics, but this isn't even necessary to know. So I bring this up for the sake of kind of demystifying volatility here. You really don't need to know this formula. And I say that sincerely. You need to understand what's going on, but you don't need to know how to calculate it in order to use volatility to inform your trading. Now, in general, we're talking about the VIX being calculated in real time using the live prices of S&P 500 options, and this includes the standard CBOE SPX options. They expire on the third Friday of every month, which again is tomorrow. We have the weekly CBOE SPX options that expire every Friday, and to be considered for the VIX index, an option must have an expiry date between 23 and 37 days, which is why we say, on average, we're talking about what does the certainty or uncertainty of the market look like in a 30-day window. That's why I
Now,
say it's a non-standard time series, Todd, because we're not looking
yeah.
at 60 days out in the future.
So I've got a little anecdote on this slide. I did my best friend growing up. We talk about the CBOE. I traded on the floor of the CBOE for a number of years, and I brought him out from California to come trade on the trading floors, and I sent him a book that showed a lot of this mathematics. And I also hear, when I talk to some students today, because I do go and I speak to college students as well as high school students, and people always wonder, is math practical? And it is. I mean, these understanding what's going on in the markets, when you look at things like the VIX, it's applied mathematics. This is differential calculus. Now, do you need to know differential calculus? No. I sent my friend the book. He read the book, and I said, listen, some of the stuff, it's going to look like differential calculus, and that's because it is. But in the end, and the truth of the matter is, and this is something I did when I was at E-Trade and now that I'm doing at Nadex, you do not need to understand how these numbers are calculated. It's simple, knowing that they exist and that there is a true mathematic logic to it. And the way that the anecdote that I use is this: if you want to get from point A to point B, and you're going to use a car, do you need to know the internal workings of an internal combustion engine in order to get from point A to point B? Do
Oh,
you need to understand things like fuel injection and pistons and torque and horsepower and drivetrain? No, you can get into it and you can become a gearhead and understand how all the inner workings of a car work. But the truth of the matter is, if you're looking to get from point A to point B, you simply need, I can hand you the keys, you can turn it on, and you can push the go-y pedal and the stop-y pedal, and you can steer. As long as you know how to use the car, you don't need to know what makes the car work. And when it comes to understanding volatility, you don't need to know how the hot dog is made and all the inner workings of this measurement and how it's, how it works. You just need to know how to apply it. What does it mean? What does it mean to you, the trader? If you see this, how could you use that in analyzing your charts and looking at potential trade opportunities? And beyond that, if you want to get into the math, you certainly can. And you can see, who wants, that, to me, I don't mind looking at that, but it's terrifying. It's terrifying to look at that picture. But it is kind of cool that it's applied mathematics.
And this is us looking under the hood of the car. And much chagrin to both of my uncles and my grandfather, who are engineers, I couldn't tell you how an engine works. I know how to pop open the hood and put back in windshield wiper fluid and perhaps a few other things, but that's about it. But you don't need to understand everything, as Todd points out, in order to be able to drive the car. And that's exactly the point here with VIX. We're not necessarily trying to figure out how to calculate it. We're just trying to understand its relationship, volatility's relationship with different asset prices. And so historically speaking, there is a strong negative correlation between the VIX and the stock market and stock market returns. If the VIX is moving up, it's likely that the S&P 500 is falling in price due to increasing fears, as Todd pointed out. We call it the fear index. That's just not a marketing term that you see on CNN or CNBC, but it's actually something that people on the street call. It's the fear index. And I bring this up because when we're talking about this in general, we want to understand that there can be shifting relationships over time. So these are just general rules of thumb, right? These are our heuristics for approaching the market. There are periods when volatility rises and stock prices rise, but that's atypical. That's unusual. Now, I want to pull up this next chart here because it better illustrates the point. As you said before, show, not tell. This is a pretty clear example of what we're talking about, right? The blue line here on this chart is the VIX. We're from September 2019 through actually market close today. You can see that I clipped this chart right before the presentation started. And you could see last year during the start of the pandemic, what happened when the orange line, the S&P 500, started to fall. Well, volatility was rising. Volatility was actually shooting higher to some of the highest levels that we had seen since Brexit, since the financial crisis itself. And Todd, it's September 16th. So we are looking at the 13-year anniversary of Lehman Brothers. Yeah. And so the last time we had seen
and just for posterity, not only that, it's the Lehman Brothers, it's also Mexican Independence Day. So while we got Lehman Brothers weighing us down, we got Mexican Independence Day cheering us up. So I'm always looking for that silver lining.
Well, Todd, as you can see here on the chart, there are a few instances when the correlation between the S&P 500 and volatility turns positive. And you know what? It's not usually the sign of a market that's getting ready to extend much higher. We've seen a few spikes higher in the correlation when it actually flips from negative territory to positive territory over the last 2 years. But these have typically preceded bigger market downturns. In fact, we saw this last September, a year ago, when volatility was rising alongside the S&P 500. And sure enough, the market came down thereafter. We saw it here at the start of, or rather the end of 2020, which preceded a sideways move. And again, we saw it here in May, and that was before another sell-off in stock. So
And
one
and,
of the,
and
go
I want
ahead.
to ask you, when those happen, right? It doesn't always mean there's going to be a sell-off. So is that's just potential expectations of something happening? And I mean, I don't know. We'd have to go back in time and have to look at each one of those periods if anything was particularly going on at that moment. But it is something that would alert you to take a peek. Yes.
Absolutely. You know, when we talk about trading in general, we're making probabilistic bets on what will happen. Nothing is guaranteed in the market, right? The market will always outlast you. The market can stay irrational longer than you can stay solvent. But when we see these type of relationships change and we see the relationship between volatility and stock returns go positive, that to me is a warning sign. We can use it as kind of a signpost on our road when we're going from point A to point B to say, you know what? Maybe it's time to scale back risk. Maybe it's time that I look for short opportunities. Maybe I should rein in my expectations about potential upside moving forward. It's not a guarantee that the market's going to fall thereafter, but it could mean that risk appetite itself has reached a near-term peak and we're due for a period of caution or perhaps even animal spirits subsiding. And so that's why I bring this up, because again, it's not guaranteed. You don't see a perfect negative correlation here of -1. You see this relationship ebb and flow over time. And when that relationship becomes less negative and goes towards positive territory, even flips into positive territory, that's usually when my alarm bells start going off, that we should be looking out for some difficulties ahead. And that helps inform other trading decisions. Do I need to be looking at, treasury bonds? Do I need to be looking at FX? Do I need to be looking at different precious metals? And quite frankly, when we saw here at the beginning of May, when the relationship between volatility and the S&P 500 turned positive, that preceded a rally in precious metals and gold and silver. And so, we can use this information not simply just to inform what we're looking at in the S&P 500, but we can actually use it to help inform other parts of the market as well.
For sure, yeah. And in a risk off or a risk changing environment where people might be shifting assets between different asset classes to diversify their risk, it creates opportunities elsewhere.
Exactly. So just to kind of recap here before we move into the S&P 500 to apply some of this understanding, we'll talk about the VIX and how it's been trading recently. We'll look at the S&P 500 to see how it's been trading recently. But I just want to do a quick recap here. Volatility itself is a measure of the movement of an asset's price rather than the price of the asset itself. This means when you're trading volatility or looking at it to inform your trading decisions, you're not focused on the direction of change, but how much the market has moved and how frequently movement occurs. And that's why we're looking at the VIX quoted in percentage points. So for the past several years, when the VIX has been hanging out below 20, it's considered to be a period of stability for the market. And when we see spikes above 20, but more importantly through 30, that's when alarm bells start going off for traders. This has been the case for the past year. You could actually see some of the bigger downturns we've had over the past 2 years. In fact, in the S&P 500, they've occurred when we've seen spikes above that 30 level in the VIX. There have been other spikes where we don't quite get to 30, where we do climb above 20, and they mark near-term drawdowns in the S&P 500. But in general, that's the heuristic that I use. If we're below 20, we're fairly stable. We're in fairly normal territory. And if we're above 20, we may want to have a little bit more caution. And if we're above 30, we should be seeing a little bit more downside in risk appetite in general. And so while the VIX is go ahead.
I was going to say, we'll discuss this when we go over to the platform and we start looking at charts. Mm-hmm. But it does beget the question: if we're hovering down here below 20, are people becoming complacent? But we'll take that, pin that up to the side. Because there are some concerns about what the future holds. But according to what we're looking at today, as of this morning, as of earlier today, where the VIX level is, there doesn't seem to be a whole lot of concern at the moment.
Not right now, which is surprising because you have what's happening in China right now with the Evergrande Property Group. The second largest property developer in China is going through a host of issues. Looks like it may default on its bond payments next week. Investors talking about a 75-80% cut on on their holdings. Equity has been wiped out over the last few weeks. We also have the U.S. debt ceiling talks coming up. And so I remember 2011. That was my baptism by fire when I was first out of the market. I graduated at college in May that year, and come August, we have this 4-day swing of plus or minus 5% moves in the Dow Jones after we see S&P downgrade, Standard & Poor's downgrade the U.S. credit rating from AAA. Actually, I could tell you where I was. I was with David Song and Michael Boutros, and we were sitting in a bar right off of Wall Street. And all of a sudden, right at 4:10 p.m., all of a sudden you see this red flashing icon logo across the screen, breaking news, S&P 500. S&P, downgrades the U.S. I can't tell you how many people ran to the bar and started ordering drinks.
So let's get into that, because I want to keep moving toward that, because I want to get over to where we start playing with the charts and analyzing and looking at what you could potentially do as volatility moves and as things spike. How do you use it to potentially do things in the markets?
Sure. So one thing that I've noticed recently here, Todd, is the fact that we've seen a few spikes in volatility begin to crop up together over the past few months. And typically, when you see spikes in greater frequency, it means the market's becoming less and less stable. And recently it appears that the S&P 500 may be coming under a little bit of pressure. Now, seasonally speaking, we are heading into the worst 3 months of the year, or worst 3 weeks of the year, if it's on a 5-year, a 10-year, or for some reason, as John Kicklater presented to me today, the 100-year seasonal pattern of the S&P 500. These weeks of the year are literally the worst weeks of the year for return in the market. And when we take a look at the S&P 500 from a technical perspective, there may be some reasons to think why volatility could be churning higher, that those concurrent spikes that we've been seeing recently over the last few months may be giving way to some more uncertainty in markets. Now, fundamental reasons aside, Evergrande's debt ceiling, whether or not the Fed's going to taper, I do want to pay attention to the technicals, because I do think that they're an important guide for which way price action may be moving henceforth. Now, although I am a fundamental investor and trader first and foremost, I have an entire matrix I use, which countries, central banks are doing what, relative inflation rates, what's going on in the bond market. The fact of the matter is that those are the fundamental notes. And as Todd said before, going from point A to point B, I view the fundamental story of I'm going from New York to LA. I'm heading from east to west. But the technicals, that's the actual direction of the market. That's, where do I need to stop off and get gas? Where can I go fast on the highway? Where do I need to take a night's rest so I don't fall asleep at the wheel? Where are the twists and turns coming? And right now, it appears that there may be some twists and turns coming, because there's a few relationships that are coming under pressure. First and foremost, at the start of this month, we were beginning to come back to that rising trend line from the pandemic low and the swing low that we had earlier this March. So that's March 2020 and March 2021, this solid black line here going from the bottom left to top right of the screen. And you could see more recently, we ran into that, and well, we couldn't climb back through there. But perhaps even more concerning, if you want to take a look at this from an economic regime perspective, we go back to November, right before the US elections, when markets began pricing in a Joe Biden victory. And what do we see here? Well, this dotted trend line, this has become under pressure as well. So same chart, just zoomed in here. What do we see? Start of September, we can't really climb back above our pandemic trend line. In the last few days, we've been dancing along the trend line from the November 2020 low here. Now, there's one other line here on the chart that draws my attention, and that's the 50-day moving average. That's this blue line that's squiggling its way up, crossing over our dotted line here. A 50-day moving average, it's something that a lot of traders look at. When you're looking at moving averages in the market, they have to have some rational sense for why you're using them. Either they constitute a solid period of time, like I use the 21 EMA a lot because there are 20.7 trading days in the average month, and if you round up, that's 21. I prefer EMAs to SMAs on a short-term basis because they more readily reflect near-term price action. But the 50-day is one of those moving averages that's not only a solid round number, it's something that a lot of people look at. You hear the 50, you hear the 200. Well, the 50-day moving average over the past, say, 6 months has been, and even longer than that, going back to the start of this year, has been rather reliable. In fact, we have not seen 2 consecutive closes below this 50-day moving average at any point this year. And so where do we find ourselves today? We're challenging that trend line, dancing along our dotted trend line here, going back to the November low last year. We also find ourselves beginning to consolidate right above the 50-day. So why do we bring this up? Because if we see that volatility starts to spike again, if we see ourselves moving back above that 20 level, I think that increases the odds that we're going to see a more substantial breakdown here in the S&P 500. And if volatility comes back in, we have a tradable low to work with for the month of September. Like I said before, we're not in the nicest part of the year right now. Coming out of the summer, going into the Fed meetings, with the debt limit ceiling debate coming up, with this news out of China, and of course, where we fall in the cycle, this 50-day moving average may become something of greater focus over the next few days, few weeks, as traders try to discern whether or not we're due for a near-term top. Todd, I know that this is something that you look at as well. What are your thoughts around this 50-day moving average and price action we've been hearing?
It is definitely something to be watching. I also think that there's everyone talking about September, and then in the industry we'd call it Rocktober, because that's actually when the markets would get rocked. Interestingly enough, October tends to be historically the worst events have tended to happen in October, not so much September. But I think that there's people that are starting to position themselves and look at exactly this chart. They're saying, hey, we are coming close to this 50-day moving average. Is this, and I think people are starting to reflect, pause, examine, maybe starting to do some risk off positions. But interestingly enough, we're not necessarily seeing that so much in the VIX itself, which I find interesting. So the S&P is starting to consolidate here. It is starting to, hit a little bit of a rest period, and it is on the downside as people wait and see, and people have some expectations that the markets could bottom out at any moment. But you're not seeing that so much in the options, in the fear index yet. So I just find that's rather interesting that we would see that in the price of the S&P, but not yet so much in the VIX.
And that's certainly something we're going to be watching moving forward. And I know, Todd, we're going to delve back into the equity indices later on. We can not only use the information that we've talked about thus far to talk about stocks, but it's applicable to other asset classes as well. And similar to stocks, there's crude oil and OVX. Now, crude oil prices have a relationship with volatility like most other asset classes because they have real economic uses. We're talking about energy assets. We're talking about soft and hard metals being your iron ore, your nickel, right? Precious metals are in a separate category, and we're going to talk about gold a little bit later. But when we talk about volatility in oil, oil is similar to stocks. Oil typically doesn't like higher volatility because it means there is uncertainty over perhaps demand. Now, just a quick little statistic on demand. If you were to take a longer term chart and plot global oil demand on a quarterly basis against oil prices for the last 30 years, the correlation is 0.97. So as oil demand goes up, price tends to go up. That's been one of the hard and fast rules that we've seen for almost as long as I've been alive, Todd, for a good chunk of your life as well.
Oil is definitely a supply demand. I mean, that is what moves oil markets. That, and there can be the occasional external event, for instance, weather in the Gulf region or war in the Middle East. Outside of that, it is definitely supply and demand. And those events, like weather in the Gulf or something going on in the Middle East, that really affects the supply side of the equation. So I'll go back to it. It's all about supply and demand.
And so when we see higher periods of volatility in OVX, we tend to see weakness in crude oil prices. When we see oil volatility trending lower, price tends to go up. Now, why would volatility come down? As Todd just pointed out, supply and demand. When there is less uncertainty over, say, what OPEC might do, or over what's happening in the Gulf Coast region of the United States and Mexico. Mexico is a big oil producer. The United States is a big oil producer now. In fact, the United States has been exporting more oil than it's been importing for the past few years, for about 5.5 years now. And so we're talking about a situation where oil volatility tends to have a negative correlation with price. Now, we can measure oil volatility using the CBOE's oil volatility ETF. You have to ignore my typo here on the screen. Not everyone's perfect. OVX, and this tracks the 1-month implied volatility of crude oil as derived from the USO option chain. Now, USO is an ETF that basically packages up crude oil futures, and it's constructed in the same way as the VIX. So we can go back to that nasty looking formula earlier, or we can simply go to the next chart, which I think everyone would prefer here. Now, what have we seen? Well, what happened last year at the start of the pandemic? Our blue line here, oil vol, started to go up. And when oil vol went up, our orange line, oil prices, came down. And what's been happening ever since then? Well, we've seen a few spikes in oil volatility corresponding with some downdrafts in oil prices, but the general thrust has been lower peaks in vol and lower and lower and lower oil volatility, which I find actually pretty important because oil volatility and oil price, well, it's a very similar relationship to what goes on with the VIX and stocks. When we see periods when the relationship turns positive, it typically precedes a bigger downdraft in oil prices. We've seen this a few times this year, going back to early 2020, actually. We have it again here at the start of May 2020. We have it here in March 2021, when oil volatility and oil prices began to align in a positive manner, and that preceded a period where there was a bit of weakness and then ultimately sideways shuffle for about 2.5 months. But recently, oil volatility has been coming down, and the relationship between oil volatility and oil prices has been deepening into the negative territory, approaching that perfect negative correlation of negative 0.1, and that's been great news for oil prices. Now, I should have brought a longer term chart here, and Todd, you can fill in my lack of information when we flip on over to the trading platform later. But we have here on our screen this descending trend line from the July 2008 and the July 2014 highs. Now, the July 2008 high was the all-time high in oil prices. And what have we seen here in price action the last few months? Well, after chopping sideways through that long-term trend line, we entered a bit of a consolidation. In fact, we got a bit of weakness here off the highs that we had in July, and again, right here, start of August. But recently, as we've pointed out, oil volatility has started to come down. Oil volatility continues to slump. The relationship between oil vol and prices is deeply negative. And as oil volatility has cooled off, oil prices have started to break out again. So Todd, perhaps the reason why we're not seeing a corresponding rise in VIX for the S&P 500 is the fact that oil prices are going up. And if oil prices are going up, that should mean demand is going higher. And if demand's going higher, then those concerns around the Delta variant may be overblown.
Yeah, and that is actually a great point, right? As we're seeing oil prices going higher. The reason oil prices are going higher, demand is going up. Why is demand going up? Demand's going up because the economies around the globe are recovering, in which case that would actually kind of support the notion that, and that's why the volatility in the S&P isn't going up, is that things actually are better than what people are expecting, even though historically this has been a rough time. But historically, we haven't been coming out of a pandemic. So, this year could certainly be a year different than what we've seen, happen in the past during these last months of September and October, because we are coming out of that pandemic, and because economic indicators and forecasts are that things are heading back in the right direction after, some really difficult, troubling times this past, oh my God, I'm going to say almost 2 years, a year and a half, year and 3/4. So yeah, this does paint a different picture for the stock market this year in terms of with the recovery going on.
As oil prices are going up, it actually may help inform what we're talking about the S&P 500, because if demand for oil is increasing around the world, that's pushing up prices. It speaks to a positive economic environment. It also probably means, from my opinion, it means an environment that we see demand within economies themselves strong, not for oil, but for goods and services, which means corporate earnings are relatively intact, which are still on a positive upswing. I know that they are among their highest levels ever in terms of expectations moving forward, and that may be a concern for some. But in terms of relationship that we're seeing with oil volatility, and what's happening in the stock market, this could be a canary in the coal mine that suggests, you know what, that 50-day moving average in stocks will hold, that after this period of tumult and the end of summer and a few weeks here around holidays, if it was Labor Day, if it was Rosh Hashanah, Yom Kippur, and now, of course, all that comes to a close with the options expiry tomorrow and then the Fed meeting next week, perhaps we're coming out of the woods and risk appetite may be getting back on the path to resume its upward trajectory. Now, we've talked a lot about the typical relationships here. We've talked about stocks, we've talked about oil, but gold tends to be the exception to the rule. Gold prices historically, they have a relationship with volatility unlike other asset classes. Because while other asset classes like bonds and stocks and even some commodities, they don't like the increased volatility, signaling greater uncertainty around cash flows, dividends, coupon payments, etc. Gold actually tends to benefit during periods of higher volatility. Now, just like we had the CBOE's oil volatility ETF, OVX, the CBOE has the gold volatility ETF, which tracks the 1 month implied volatility of gold as derived from the GLD option chain. Again, gold futures packaged into an ETF that they roll over, same methodology as the VIX. When we see falling gold volatility, it actually may mean that gold prices may slump too. Why? Because if you're not expecting uncertainty in the future, you're not going to hold on to something that doesn't necessarily return money to you. Stocks have dividends, there are cash flows, bonds have coupon payments. If you're optimistic about the future, that typically means that you're going to see a better performing economy. And that means there may be inflation. Well, gold doesn't necessarily offer you a return on its holdings. And so when there's less volatility in the gold market, it typically means you're heading into a period of weakness for gold prices.
So,
Now, what do we see here
actually, I
over
know
the past
you're
2
about to do
years?
this,
Well,
Chris. I was going to ask you a question, just because I know it was topical to something you've done recently. I know that you go on the macro setup. If people aren't familiar, we do the macro setup once a week between IG and Nadex, and Chris is our go-to guy for. And the macro setup is a show put on by Guy Adami and Dan Nathan, whom you might be familiar with over on CNBC. But Chris, I know that there we go. I know that recently, you had some concerns about the price of gold, and in fact, gold has dropped significantly today. I mean, we're seeing some significant volatility in gold in the last day, today, and even yesterday. How has that been? How has your opinion been formed by looking at some of the things like volatility in gold, or the volatility measure in gold?
Absolutely, Todd. Gold volatility has actually been the tell for me in the sense that when gold prices have been rallying, we haven't been seeing that corresponding increase in gold volatility. Now, that's atypical. These relationships, they tend to ebb and flow over time, but it's not something that we like to see. We like to see a market where gold volatility shoots up because it means that there's something going on in the US economy, in the broader world, that warrants people to step back and say, I'm not so sure about these central banks. I'm not so sure about these fiscal authorities. I don't think they're that competent. And so when gold volatility stays low in the face of a rise in gold prices, I'm doubtful. I don't have faith in that move in gold prices. And you know what? Over the course of this year, while there have been swings higher in gold vol, and they have matched an increase in gold price here, the swings higher in gold volatility haven't been sustained. Now, it's not just that. We're not going to go too deep into crypto. That's certainly a whole conversation unto itself for another time and place. But when we think about pensions and portfolio managers, in this world of perhaps high inflation, has gold been keeping pace with inflation over the past year? Actually, no. Gold prices are down year over year. But it's not cryptocurrency. So if you're a portfolio manager, if you're someone who invests for the long term, there's also the possibility that they may be allocating incremental dollars that come into their funds to crypto and not to gold anymore. And so this environment where gold volatility is trending lower over a multi-month period, and there are inflation concerns, gold prices haven't been able to rally. That doesn't make a lot of sense fundamentally. And we're starting to come out of the period, right? We're talking about a Fed taper. We've already had the ECB taper. We've had the RBA taper and the BOC taper and the BOE taper. And we're having struggles on the fiscal front here in the US in terms of what the infrastructure package will look like. There's all this talk about a fiscal cliff next year and perhaps the US government shutting down in the next few weeks, which means less government spending, bad for growth, bad for inflation. Gold really hasn't been benefiting what should have been the best fundamental environment in history, Todd.
And the question is, yeah, and I guess ultimately we'll find out is, are those incremental funds finding their way into a different asset class like cryptocurrencies, or are people sitting on the sidelines with gold, not waiting for the indication that interest rates are going to rise, which would drive inflation, right? That's going to change the inflation equation. Are they waiting for for central banks to actually start raising interest rates? And we'll see what happens there. I'm not certain, but it is an interesting question, isn't it?
For sure. And what happened today was rather alarming, right? We saw gold volatility tick up. Just if you keep an eye on the change in the charts here, gold volatility is this blue line, price is the orange line. When gold volatility ticks up today, prices come shooting down. That's not a good sign for me. That's not something that I think is constructive. It's not something that gives me faith in the near-term outlook for gold prices. And when we take a look at our technicals, our guidepost here, there are some signs of alarm that should be ringing. On these rallies in gold prices over the past few months, past few weeks in particular, we weren't really able to clear those highs that we had back in July, this cluster of Fibonacci retracements measured going back to the lows that we had in 2015 to the 2020 high, as well as the 2020 low to the 2020 high. And what do we see here? Well, this ascending trend line from the May 2019, March 2020, and then March 2021 lows, we've cracked below that today. We've seen here that this potential near-term symmetrical triangle that's encompassed price action in 2021, another false bullish break back into the triangle, and then we come crashing back out. This to me is a warning sign. The technicals are weakening, and perhaps importantly, this flag that we had been trading in off the highs last year that encompassed price action going back from August through about April or May this year, we're now back in it. So yeah. Gold volatility in general has been trending lower. Recently, the spikes in gold vol have been accompanied by downdrafts in price. That is atypical, and it is not something that
that's interesting. That is interesting because it's the market seems to be adapting a little bit differently than it has historically.
And you know what? This may be something that is temporary and short-lived. We could be looking at a slew of potential concerns over the next few weeks. Let's say the Fed doesn't announce a taper. Let's say Evergrande is China's Lehman moment. Let's say the US loses another one of its credit ratings. These things historically have proven to be beneficial for gold prices. But right now in the near term, absent some, we've talked about them, so they technically can't be black swans. Black swans are risks that people don't consider. And for us considering them, I guess they're gray swans. Nitpicking terminology aside, gold does not look like it's healthy. It does not look like it's in territory where I have faith on a technical perspective. It failed to take advantage of what was the best fundamental environment in recent history. And we're starting to see weakness set in here with prices such that we're just losing many significant levels all at once. And so Todd, just to kind of recap here, volatility, it can be used as a tool to help inform the direction of various markets. For stocks and for oil, when volatility increases, stock prices tend to come down. Oil prices tend to come down. And when volatility falls, the opposite is true. Stocks tend to go up because there's less uncertainty. You're going to feel better about something when you know that you're more likely to receive those dividends or those cash flows. You're going to feel better when you think that there's substantial demand for oil. But for gold is typically, historically speaking, it tends to rise when volatility rises, because that means there's broader uncertainty in the market. People are reaching for a safe haven, and gold, as many say, is the ultimate hedge against sovereign incompetence. So the fact that we're seeing gold prices fall now, Todd, it's not an environment that I'm that kosher with.
All right. Well, and we will get into that when we jump over to the platform and start playing around a bit.
And so to quickly recap, if you just joined recently, you didn't hear me at the beginning, my name is Christopher Vecchio, Senior Strategist with DailyFX, CFA charter holder. I have degrees in political science, macroeconomics. I've lectured at Duke Law School on derivatives trading. Here at DailyFX, we produce articles highlighting fundamental and technical items of interest. We also have implications and projections for what might be occurring in markets. We share these through written articles every day, as well as live webinars over the course of the week. We publish weekly and quarterly forecasts each week, each month. You can find us on various channels. You can follow me on Twitter, for example, at CVecchioFX. And we also support IG and Nadex with research and education events like this. And it's been a real pleasure, Todd, to be the primary person here talking through everything today. But I think they've heard enough of me. I think it's time to pass the baton over to you.
Fair enough. All right, fair enough. Now, Chris, I want to thank you for all that, because you set up a great story. Is what is volatility? How do you measure volatility? How can you potentially use that when you're looking at charts or informing your trading decisions? Now the question is, what can you actually do with this? What can you actually do with this? And I'm actually now going to talk about Nadex markets. I want to talk about Nadex products, and then Chris, you and I are going to jump into the charts. So I am going to give this as an opportunity now. One, if there's something you would like Chris and me to discuss, by all means, put it into the questions box. You can click on that question mark. You could type your question in and send it off. And again, I want to remind everyone that this is being recorded, so you'll be able to go back and review everything Chris had to say, as well as what I'm about to cover. So Chris, I'm going to take control back from you real quickly. And what am I, let's see, it's going to take me a second here. I want to do, nope. There we go. I think I just switched it over to my screen.
Yes, sir, I can see.
All right, perfect. So what I want to do, and I'm not going to spend much time on this. I'm only going to spend a few minutes. I only want to spend a few minutes. I want to make sure that, am I sharing the right screen? There we go. Okay, good. I don't want to spend a lot of time on this because I want to really get into the show me part of this. I mean, I think that's really, we've learned a lot about volatility, what it means, and why it's important. And I want to get into how can you actually use it. But before we get there, I would like to cover a quick introduction, a very short quick introduction to Nadex binary options. Now, I do have to share this disclaimer quickly. Of course, whenever we show anything that trading involves risk, it might not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. But this is an educational session. Please do not construe anything either Chris or I say as a buy or sell recommendation. We're doing this for your education purposes. And clearly, when we start bringing up more live charts, that's going to become infinitely more relevant. If you were curious, we've gotten a quick bio on Chris on all of his incredible experience in being able to interpret the markets. I also have a extensive background in the financial services markets. I spent years on the floor of the CBOE, and then I went to work for the exchanges and brokerage companies, whether it was Eurex, and if you're not familiar with them, it's Deutsche Börse Group out of Frankfurt, Germany. Box options, equity options here in the United States. In fact, we invented price improvement, which brought penny options to all retail traders. It was kind of a fun time. Then I was at the New York Stock Exchange as well as E-Trade before I came over to Nadex. I grew up in California, even though I was born in the Midwest, and I've got my BA as well as my MBA from UCLA. Now, I am going to quickly define binary options for anyone on here who has not ever traded a binary option And I want to just do a quick review so that when we get over to the charts, it starts making a little bit more sense. Now, the truth of the matter is everyone probably knows what a binary option is. You just might not have called them binary options. But a binary option is a short-term contract, and it's a defined risk contract. And that is what I really want to emphasize, is the fact that when volatility and you're trading in the markets and you see there could be some alerts, and we are going to jump over, I mean, I think we'll start probably on the gold charts, because there's something that's concerning Chris about what he's seeing in the price of gold. And I think, I think you called it a warning sign. And when that happens, the question is how do you act on those impulses, but then control your risk so that if in the event that you're wrong, you're protected, but in the event that you're right, you can also profit. And binary options is a great way to do that. And a binary option is simply a prediction. It is a prediction, it is a statement, and it's made up of three components. And the example here, an underlying market, a condition, sometimes also called the strike price of the level, and a time, an expiration time. And for example, since this is probably where we're going to start, and again, I'm encouraging everyone, if you want to see a particular market, tell us, but I'll start with gold. The question on the binary option is, will gold settle above 1760 an ounce in the next 2 hours, or at the end of the day, or at the end of the week? So some sort of expiration time. Will gold be higher than this price at this time? And that's a binary option. And in the end, it's whether you're buying a binary option or selling one, and you can sell them, and we'll look at that as well. Your risk is known up front. So is your reward. They're defined risk reward contracts, which is a great way if you're trading short-term price action for you to potentially make money and find trading opportunity, but to also limit your risk in the event that you're wrong. And a binary option at Nadex trades between 0 and 100. Now, what I do want to talk about is what that 0 and 100 represents. Now, I mentioned a binary option. It's either a true or false prediction. And that's why it's called a binary option. There are only two outcomes in the end. If the outcome is true, the contract goes to 100. And if the statement is false, it goes to 0. Will gold be higher than 1760 per ounce in the next hour? If it's above 1760 an ounce, it goes to 100. And if it's at 7060 or lower, it goes to 0. That's why it's called a binary option. In the end, only in the end, it's essentially an all or nothing. It either goes to 100 or it goes to 0. There are only two outcomes. But I really emphasize in the end. Now, what is that number that we're talking about? That 0 to 100. And this is applied mathematics again. This is that option model that Chris showed you earlier. But the price is really what you're looking at. It's the probability at that moment in time that the event is going to be true, that it's going to go to 100, that it will settle above that strike price. Right? So really what you're trading is the probability. And because there's time and then to expiration and volatility, and this is why I mentioned this, those will impact the price of a binary option. So if in highly volatile markets or with a lot of time left, the price of the binary option will accommodate for that. If there's very little time left or there's no volatility, the price of the binary option will reflect that as well. And so understanding what Chris was talking about regarding the volatility measures and the uncertainty measures, those also impact the price of binary options. Now, from a math standpoint, and if you're an options geek, interestingly enough, the price of a binary option is the first derivative of what Chris was, that formula he showed you. It's the tangent at the line. If you want to get into the calculus of it, it's the rate of change, which if you trade options and heard the term delta, and delta means a bunch of different things, that's what the binary option is. That price of that binary option is essentially the delta at that moment in time. And so if you're an options trader, understanding how binary options work, that would help you out. But they're as simple as a statement. Will gold be higher than a price at this time? Yes or no. Will the S&P 500 be above this price at a certain time? Yes or no. Will the Euro US dollar Forex pair be above this price in the next 5 minutes? Binary options are a great way to take an opinion. And if you're into volatile markets where prices are moving around, which is volatility, binary options are a way for you to reflect that opinion, for you to try to profit from your opinion on whether the price of something is going up or going down, but you're doing so in a very limited risk, limited reward way. And the emphasis there on limited risk. Now, that price, that number that you're looking at, not only is it the probability that the statement will be true, because Nadex binary options are also $100, it is also the actual price that you're trading. So this is the kind of the cool thing about Nadex binary options is you can get into the markets and you don't need thousands of dollars like you would potentially need to trade other futures contracts. You can get in with just tens of dollars or hundreds of dollars, and you could start trading your opinion in the markets using Nadex binary options when a total value of a contract is only 100. So if you're trading a binary option that is trading, for instance, at 50, all right, will gold be greater than 1750 an ounce? And currently gold is trading 1750 an ounce. Well, I don't know. In the next hour, it could go up, it can go down. There's an equal likelihood or probability that it would go up or down and settle up or down. So the price of the binary option is going to be around 50-50 or 50% of it being true. It's also $50. You're risking $50. And if you buy it, you're hoping that the statement is true and it goes to 100, in which case you risk 50 to potentially make 50. But if you risk 50 and it goes to zero, you're risking 50 and it could go to zero. If you don't think gold is going to settle above 1750, you could sell it, saying, I think this is going to zero. I don't think gold is going higher. I think gold is going lower. And so all of this, the math is done for you on the order ticket. But when you're trading binary options, you cannot lose any more than what you initially put into a trade, because the collateral that you put up is the maximum risk. Whether you're buying or whether you're selling, you put up your maximum risk. You can't lose any more than that. And it's a way for you to get into the markets and manage your risk exposure, but still try to profit from your opinion on whether something is going up or something is going down. Now, I do want to just show an order ticket briefly, because all of the things I just mentioned are given to you on the Nadex platform. If this is a simple order ticket, and this is for the S&P 500, and you can see at the top of the order ticket, one, it tells you the price the S&P is currently trading. It's against the futures contract. Two, it tells you the time frame. This is going to expire in an hour and 23 minutes. At Nadex, we've got short-term trading opportunities. You want to trade something in the next 5 minutes? We've got FX pairs. You want to trade something in the next 20 minutes? We've got all the equity indices, the US equity indices. You want to do something in the next hour or two? All of our products have got hourly or 2-hour windows, as well as daily and weekly. The condition is given to you right at the top of the order ticket, and you'll have a bid-ask spread. Now, if you look at that bid-ask spread, if you're buying, the middle of that bid-ask spread is going to tell you the probability at that moment in time that the market is pricing that this is going to go to 100, and you see that at the bottom of the order ticket, the probability of it being in the money. Now, you also can enter your price. You do not have to trade. You do not have to sell on the bid or buy on the offer. You can place limit orders at Nadex. Something that differentiates Nadex from all the other binary option providers out there is that we have a central limit order book. You can say, I'm willing to pay this, or I want to sell at this. You can put your prices into the market. Whatever your opinion is, you can do that. We will calculate for you your maximum potential profit and your maximum potential loss. And I love this at the bottom of the order ticket. It actually calculates everything for you. It tells you your probability of it being in the money and it going to 100. If you're selling, it would be 100 minus that number, because you're looking for it to go to zero, not up to 100. And then your return on investment. How much am I risking and what could I potentially make? What could I potentially make if I held it to expiration and it went to 100? Now, this is something that is absolutely critically important. So I'm trying to alert you to pay attention at Nadex when you're trading binary options. And this is something else that differentiates Nadex with other binary option providers. Just because there's an expiration associated with the contract does not mean you have to wait until then to see what happens. And that is absolutely important. Just because there's an expiration, that previous order ticket, there was an hour and 23 minutes to go. Did I have to wait that hour and 23 minutes to see if it was going to go to 0 or 100? And the answer is no. You can choose to exit your position early. I'm going to say that again. If you buy or sell binary options at Nadex, you can day trade them. You can position trade them. You can exit your position. Now, why would you exit it? One, you would want to lock in a profit. Maybe you see an opportunity, you think oil is going to go lower, and you sell a binary option that's currently trading at 80. There's an 80% chance the statement's going to be true, but you think it's going to go down. You sell it at 80, and it does go down. It goes right to where your condition is. It goes right, and I told you earlier, if it's right at the condition, it's probably going to be priced around 50-50. So around 50. Well, you sold it at 80, you can buy it back at 50, and you made $30. And now you could have waited and potentially made all 80 if it went to 0, or if it went back up, if the statement was true and it went to 100, you would lose 20. But you can lock in a profit. You can lock in a profit, or you can limit your losses. And that's the other thing. Yeah, some people like to trade high probability binary options. They like to buy ones that are at 70. They'll risk 70. Looking for it, and there's a high probability at that moment in time that it'll stay above the condition and it goes to 100. So they're risking 70 to make 30, and yeah, they'll be happy making $30. Not quite a 50% return on your money, a little lower than 50% return on your money, but they buy it at 70 and it goes down to 40, and they go, wait, I misinterpreted the chart, I was wrong. They do not have to lose all 70. They can take their lumps on that trade, liquidate the position, lose 30 instead of making 30, but live to fight another day. Really important when trading binary options. Now, that was my very quick primer on binary options. I want to get over to the charts with Chris, but I mentioned earlier, if you want the slide deck, we'll get it to you, but you'll need to email customerservice@nadex.com. So if you email customerservice@nadex.com, that is how you will get Chris's slide deck. So something is going to be required on your part. If you email customerservice@Nadex, you can request that slide deck. And you can also ask them any other questions at all about Nadex markets, Nadex products, your account at Nadex. So it is important. I would also recommend you follow us on social media. This session was recorded. It will be available on Nadex's YouTube page. So you'll be able to go back and review this eventually on the Nadex YouTube page. And as Chris and I are about to do, and we're going to play around with charts every morning, 8:45 a.m. Eastern, I do a live stream and we look at hotspots in the markets for that day. So tomorrow morning, we're going to be doing one. What's going to be the hot spot? Is it gold? Is it oil? Is it one of the equity indices? Is it a Forex pair? And we actually get into the charts and we do a little bit of analysis, and it's live streamed. So if you want to join us live, follow Nadex on YouTube, subscribe, set reminders on the live streams, and join us. Would love to have you in the morning. We have quite a crew every morning. Before we jump over to the platform, if you're at Nadex, or even if you're new to Nadex, we do have a refer a friend program. A lot of traders like to trade with their friends. I get it. It makes a lot of sense. They analyze the charts together. They look at volatility measures. They look at where they're seeing support and resistance. They look at their channels and they look at their technical indicators. They trade with their friends. If you refer your friend and if you have an account at Nadex, you've got a personal invitation. It's at the bottom there where you can invite, and it's your own link. If your friend uses that link and they do 5 trades within 30 days of applying for their account, they get $100. You get $100. It's like Oprah. Everyone gets $100. And you can do that with up to 10 of your friends. So 10 of your friends can each get $100 in their Nadex account. You would end up with $1,000 in your Nadex account, and you could trade with your friends. and it makes trading a little bit more fun. Now, with that, I do want to get over to that off-roading session. So I'm going to bring up the Nadex platform, and Chris, let's play around with some charts, and we're just going to look at the Nadex binary options. We do have other products like call spreads and knockouts, which I'm not going to discuss today, but if you'd like, we've got plenty of sessions where you can learn about those as well. Let's start, because I know, Chris, you had mentioned, let's start with that gold. I think it's a great place to start. And by the way, if anyone has a product they would like to see us play around with a little bit, type it into the questions, and Chris and I will try to do this. I know we've got about 15 minutes, and I am going to let's pull up the daily contracts for Nadex on binary options. Let's pop a chart up here. Yikes. Look at that chart. It ain't pretty. So Chris, you had actually started us off with, you weren't terribly happy with what was going on, and I know you discussed this again. What are you seeing when you look at the chart of gold right now, when you take a peek at it?
Just on a short-term time frame throughout September, it's been a series of lower highs and lower lows. I mean, sometimes the easiest way to analyze these things is putting it in elementary terms, which is the chart going from the bottom left to the top right, or the top left to the bottom right. And these charts over the last few weeks, even the last few months, they've been top left to bottom right. And so, my general disposition is, if there are opportunities to look for something to the downside, that would be the way that I'm looking right now. Around a lot of these events, like today, for example, this was all kicked off around the data this morning. 8:30 Eastern, 12:30 GMT. We had the August U.S. retail sales report come out. And despite what the non-farm payrolls report hinted at when it was released on September 3rd, suggesting that the economy had slowed down, consumers, they don't really care. They're burning a hole in their pockets. They've got money to spend. That's not atypical, Todd.
Yeah.
It's August. People are vacationing. People are getting ready to go back to school, get their kids back to school. And so there's usually a bump in some consumption patterns at the end of the summer. But the report blew expectations out of the water. And so, when you think about gold's relationship with interest rates, for example, if interest rates are going up, you can have a higher return on your cash, which means, why would you want to hold an asset that doesn't yield anything like gold?
Right.
So U.S. Treasury yields go up, gold dunks. If the Fed comes out next week and says, we're going to start to taper, if the Fed comes out and says, the economy is weathering the storm, what does that mean for gold prices? In my opinion, that means we probably have more weakness here. Now, unfortunately, Todd, we don't have many historical allegories for this. We have to only look to the one that we've ever seen. The Fed truly hadn't embarked on a QE program prior to the global financial crisis. And so when we talk about tapering, we can really only use that 2013, 2014, 2015 period as our guidepost.
Right.
Gold did not do well during that period. Gold didn't bottom until 2015. It was a multi-year come down from I can tell you, September 6, 2011 high, which incidentally was the day that the Swiss National Bank put in a floor in Euro Swiss at 120. That was when gold peaked. And it was 4+ years of gold trading lower between the central banks enacting the most extreme policies to the beginning of the taper before gold bottomed. And right now we're only a year removed from the most recent high. So as far as I'm concerned, I look at gold prices right now. I see a fundamental environment that's only going to get more difficult. If there are opportunities for me to look lower on this market, that's where I'm looking. And I know that there are a lot of people who feel passionate about gold. Gold has been a big disappointment for me personally this year. I was a little bit more optimistic about it coming into this year. It just hasn't panned out.
Yeah. Now, with that in mind, and again, we're not making any buy or sell recommendations. We're just playing around with the charts, and we're showing you how some of these tools work. Chris clearly shared with you what's going on with the volatility in gold. We're watching the price of gold. Now, with that being said, if you were looking for opportunities to go short gold, I guess it would be if it were to retrace and give you that opportunity. And I'm actually going to play. Let's have some fun here. I'm going to put a Fibonacci retracement just here, and this is essentially for the month of September, just about the month of September, where we started the month off and we were at the highs in gold for the month. I am going to take it down to recent lows that we saw as of this morning, right? This is this morning where it actually hit its lows, and looking for potential places where, if it were to retrace, where could you find? Oh, there we go. Where could you find opportunities? Now, right now, at this point in time, it's sort of in no man's land, right? It's actually between these two Fibonacci levels. But if gold were to pop back up and were to either touch one of these next two fib levels, looking for some sellers to potentially step in, looking for an opportunity to go short, what could you do? You could sell binary options, right? And just for posterity, I just want to show, I'm going to show the at the money binary option right now. I mean, this is the daily binary option. This expires out in 18 hours. I mean, if you didn't think gold were going to fare well tomorrow, what could you do? What could you do here? You could potentially sell this binary option. Now, it tells you on the chart, this is where gold would need to be in that red zone for it to go down to zero and for you to make maximum profit on your trade. Let's actually, I'm gonna, if I were to, and let's just pick a midpoint, 51. Now, because you're allowed to, that is exact, I mean, that's nearly exact. If I tried to sell one at 51, all right, and I could place an order here to sell one, but on this account, I think I'm actually restricted from placing an order at the moment. But if I were to sell one at 51 and I want my probability of success, it tells me that my probability would be, if I were to sell right now, it tells me there's a 49% chance that it will go to zero and I would make my 51 bucks. Now, what's my return on investment? I'm risking 49 to potentially make 51. So, I've got a pretty good return on investment. And I love how it calculates it for you on the fly based upon the current market prices. So what could you do? And if gold settles, and what's the condition here? 1754. If gold is below 1754, all right, if it's below here, all of these strike prices above, all of them, these will all go to zero. Right? This will go to zero, this will go to zero, this will go to zero. If you do not think gold is going to get above 1766, and you could potentially sell one or try to sell one, say at 16 bucks. Could you make $16? Yeah, you'd have to risk $84 to make 16 bucks. It's a higher probability trade. It happens to be right at a level where you would expect sellers to come in. But this is how people look for opportunities to potentially profit on your opinion, but to limit your risk when you're doing so. Now, again, these are not trade recommendations. I'm simply showing you how you would use binary options. If I thought, I think buyers are actually going to step in. I know what Chris and Todd are talking about, that gold's got some pressures against it, but I do think it might retrace and we might see, some success tomorrow. You can go the other way. You could say, I do think it's gonna pop. Maybe it'll come back some. Maybe it makes it back to 1780. Could I buy something in here? Let's say I were to buy one I paid 18 for it. All right, and here's the 1766 level. Now the market's telling me there's only a 17% chance that I would be successful, right? That this is going to go all the way to 100. Only a 17% chance, but I'm risking $18 to potentially make 82. And as I mentioned, if you were to say buy this and you were looking for it to retrace, hey, I'm looking for it to bounce. I think it's going to come back to this level. I think it's going to come back to this 1777 level. Just on a technical level, I think we'll see a little bit of a retracement. I could buy this. It comes back to this price. This will be trading around 50. So I could buy it potentially for 18 and then try to sell it back out at 48 and just put an order in to sell it at 40. And so if it were to retrace, I could pay 18, sell at 48. There's $30 that you could potentially make if it does retrace. So you can play these either way. You can buy them, you can sell them. It's a probability at that moment in time that the statement will be true. And people do use binary options for short-term trading opportunity. So this is kind of what we're looking at for gold. I'm taking a look, and I'm trying to read these questions as we go. And by the way, you know something? Oh, I wish I could show you this. Is how you determine the potential profit. And remember, if I were to buy a binary option, remember these are all worth 100. If I were to buy one for 18, I'm risking $18. If I were to sell it at 48 after I bought it, I'd be selling it at $48. I'd be making $30. Now, I can tell you right now, that's per contract. If I wanted to trade more than one contract, I could trade 3 contracts. And if I were to trade 3 of them, I'd be, it would just, everything would be triple. We do have some functionality coming. It's just being tested. So I'm sort of letting you know that this is coming, that we actually have a set profit goal as an exit strategy. If you were to buy one, and let's put this back at 1, you were to buy one at 18, you would actually be able to, in your positions window, say, I want to set a profit. I bought it at 18. I want to set a profit of $30. And you can help do that, and it will do the math for you and build the order ticket, and you can place your order. So in the event that you're not in front of your computer at that moment in time, your order would still be in there. And if something were to happen, say you were sleeping or you went and got a sandwich, it would execute your trade. So yes, there is that opportunity for you to set your profit goal that is coming on the Nadex platform. Chris, next. And I love the people are punching them in. You started off with the VIX, which we know is a volatility measure that comes out of the S&P 500.
Sure.
Let's play around with the S&P 500 chart. I think this might be the last one we've really got time for. So I'm jumping over now. By the way, for equity indices, now that we do during trading hours during the day when you would actually see 20-minute binary options for the S&P 500. Right now, we're in the overnight session, so you don't see that. So, and we also have all those hourly settlements. But for the S&P, I'm going to bring up the fresh daily binary options, and let's just bring up the chart. So boom, let's bring up a chart here. And Chris, what do you want me to do? You want me to put up an hourly chart? 15, does hourly work better for you instead of 30 minutes or 15 minutes, some of these shorter durations?
Yeah, no, I like the hourly chart here. I think it's a little bit crisper.
All right, and you know what? We just did a rollover. We only have right. We had the SEP rollover. We don't have as much data as we normally would have. And if you're unfamiliar, we are trading off of futures when we're talking indices and commodities. For FX, it's spot, so we've got infinitely more data that's in there. But every quarter, futures roll over. The new oil contract is actually going to roll over. We just rolled over on the SEP, so we're now using on the SEP on the S&P 500. So I don't have as much data on this. I wish I did. You know what? Do you have your charts handy? I kind of want to go back and take a look. If you had yours handy. If you don't, it's no worries, because I know we're kind of pushing the envelope here.
I
But
can
again,
actually get them handy right now. Just give me one moment.
Okay. Yeah, because when people are trading these binary options, they tend to use shorter durations, right? They tend to, look in the last 30 minutes or in the last 15 minutes, and a lot of the analysis people are doing is looking what's going to happen here for that short-term price action. And in fact, with FX, we've got them as short as 5 minutes. In the 5-minute FX binary options. This is one of the challenges with doing things in the evening. We wanted to make a session available to everyone, but we generally do sessions like this during the day where the markets are infinitely more vibrant, things are clicking around a lot more versus doing them in the evening.
Well, I don't want to be rude, so I'm going to ask, may I take the presenter back, Todd?
Oh yeah. Okay, so let's just do this real quickly. Hang on, let me. I'm sorry.
You already got it. We're already going. We're already there.
Perfect. All right.
So, Todd, when I look at this shorter term chart, this is the S&P 500 15-minute chart, a very short term time frame where we can go back, several weeks here. But I want to focus on what's been happening in September because, just from a charting perspective, left shoulder, head, right shoulder, pretty crisp neckline. I'm keeping an eye on that 44.87 level or so right now. The way I see this, if this is an inverse head and shoulder on over the past few days that's been forming out, that could be a potential bottoming pattern. And so, the contract that I think I would be keeping an eye on perhaps would be what's going on in that 44.87, 44.90 area. I myself, given what's going on in volatility, oil vol's falling, the VIX is coming back in, gold volatility is up, but gold prices are down. This may be a sign that there's a little bit more optimism coming into the market. So, Todd, when you take a look at this kind of chart, what are you thinking about from a short-term perspective?
On the short term, and again, it does help when we're in active trading sessions. But the short term, I know that a lot of things are weighing heavy going into this time of year, and I myself have considered it. Actually, I'm not gonna say I actually did hedge some of my portfolio, and I've since taken my hedge off. I hedge things in anticipation of this, expecting to see some of this coming into this time of year, just because I know people have an aversion to risk, and we tend to see people going into a little bit of a risk-off scenario right around this time. There's different sayings in the industry, so I actually did a hedge, and then I made some money on my hedge. I've taken it off, and I'm actually standing on the sidelines because I personally think while there is going to be some weight as more people again talk about all the negative things that tend to happen in September and in October, personally, I think this time might be a little different. That's my opinion, is that the economies around the globe are recovering. Are they recovering at the pace that we'd like to see? There's some ebbs and flows, but and I know we've got these COVID variants that are coming, and I know that it's been causing problems here in Chicago, as it is globally. But I don't think everything is as negative as a lot of people are painting it. I know there's a lot of people out there saying, we're screaming, oh my God, the market's at all-time highs. Oh my God, this is, like Chicken Little, the sky is falling. But the truth of the matter is, there's a difference between the stock market and what's going on in the economy, and what's actually going on in the economy is actually bodes well. So I personally think that that a lot of the skepticism is a little overweight.
So if I may, just as a potential counterpoint to that, because I do recall the stories. My aunt was a managing director at Lehman Brothers, and she was with Dick Fuld when he was meeting with Geithner and Paulson on Maiden Lane, right off of Wall Street, back in
Yeah.
back in 2008, before stuff hit the fan. And she left that meeting. She was told, of course, that Lehman wasn't going to get access to the discount window. And by the time she gets back up to her apartment on Park Avenue, they're on TV saying they're opening up the discount window to a bunch of other banks. And so I recall having to help patch up the drywall after she threw her TV through the wall. So, we are 13 years removed from that. I'm not so sure people are going to be holding risk heading into the weekend, perhaps around this Evergrande news out of China. Who knows if this is a systematic concern? So, the way I see this, if we are rallying up into 44.87, 44.90, perhaps that becomes a level. It's been a bit of resistance this entire week that traders look to fade. It's been a point at which we've seen the market come down.
Yeah, and so I mean, there's two differing opinions, and this is the truth. This is how the markets work, right? This is how the markets work, is that everyone does have their own opinion, and that's the one thing as a trader that you all have, and that makes you different than everyone else, is you've got your opinion. And ultimately, when you're trading the markets, it's up for you to determine your opinion on what works for you and how you find success trading. Not so much what does your neighbor say or what is someone else saying. It's you understanding, looking at this, and forming your own opinion. I did get a question on how easy it is to use the Nadex platform, and I will tell you, it looks slightly intimidating at first, but it is actually pretty easy to use. We do a lot of sessions to teach people how to use the platform. My colleague Adam McCaden actually did one earlier today. I would recommend you go to the Nadex YouTube channel. You can actually follow along as he goes through all of the functions. But really, we've got our markets that you can go through, and as you can see, for instance, in forex markets, you can see how we have our hourly contracts that are available, and you're really just looking, you're analyzing, and you're looking for trading opportunity. One last thing that I want to cover, I know we've run long, and I really want to be cognizant of everyone's time. To use the platform, it really is pretty intuitive. You click on something, you'll be able to buy or sell. You'll see, it calculates all of your probabilities for you. When we have when you have a position down here, shortly you're going to see close a position. It's already on there. You can close your position. I want to get out right now, liquidate me, whether it's for a profit or a loss, or what's coming shortly is the set profit goals. And you can place your orders around the market, away from. Again, everything very defined risk, very defined reward, so you know what you're getting into before you do it. And the parting shot that I wanted to ask Chris, and before we wrap it up tonight, is this is one other thing we haven't discussed really much, but with what's going on and what we've seen lately, and here we are back in at the beginning of September, but we've seen strength in the U.S. dollar lately, right? We had weakness in the U.S. dollar in the month of August. Right? And if you're not familiar with how to trade FX, we've got different things to teach you on how to access those markets as well. In fact, yeah, we've got plenty out there. Stay tuned, and I would recommend you take a look over at our colleagues over at IG, where they do quite a bit on how to trade FX markets. But Chris, August we saw U.S. dollar U.S. dollar weakness, and now in September, as we're seeing some strength in the dollar. You got any opinion on that? This is the euro. I could bring it up in any one of the other markets here. I could bring it up where it's a little bit more intuitive, like the Swiss franc or something. You got anything on that?
Yeah, some things that I've been keeping an eye on in the market. We haven't touched these topics, but when you look at the shape of the yield curve, it's been moving in a manner consistent with what happened in 2013, 2014 around the taper, and that coincided with US dollar strength. There's also this historical relationship between inflation rates with the US and the Eurozone. To kind of get in the weeds here for a second, while there is no discounted cash flow for FX, there are a few different models out there for how you can measure values between currencies. And if you're looking at, covered interest rate parity, uncovered interest rate parity, the International Fisher equation, there are a few more that we could discuss, but again, not worth going into the weeds on. Historically speaking, when we've seen this kind of spread between US and Eurozone inflation rates, about 6 months out, you'd get more US dollar strength. So when I think about the fact that the Fed rate odds have been holding firm throughout the month of September, despite some of the concern that had crept in August, when we see that the yield curve continues to evolve in a manner where those intermediate rates are going up faster than short end rates, faster than long end rates, it makes me think that this US dollar strength is legitimate. And coming into this year, the mix of loose monetary policy, expansionary fiscal policy, When you pull out your Mundell-Fleming model, as it's called, that speaks to a weaker currency. So I think a lot of people, a lot of fund managers, a lot of traders, even myself to an extent, were expecting a lot more US dollar weakness. And so fact of the matter is, what's the pain trade in FX right now? That's a stronger US dollar. I think that
Yeah.
would be against the winds of what a lot of people were anticipating, which means there's a lot of fuel to burn there. A lot of people have to cover their shorts. So could we see more US dollar strength? In my opinion, I think that would surprise some, and that's what the market likes to do best. It likes to surprise people. So
It surprises me all the time. So no, I appreciate that. And listen, I want to thank everyone for joining us tonight. This has been a lot of fun. Hopefully you like these evening sessions. I did get one question I do want to answer because someone did ask this, and they said, is Nadex involved with payment for order flow? And this is really important, is absolutely not, 100% no. Nadex is the exchange. This is where you come to trade. We have a central limit order book. Everyone's orders go into the order book. People trade against each other. There are some market makers out there that stream liquidity in the markets, but we are not routing order flow anywhere. It all happens on the exchange, and that's it. Period. End of story. So no payment for order flow whatsoever. That is something that Nadex does not participate in, unlike what you get in other markets. What you see is what you get with Nadex. With that, again, I want to thank everyone for joining us this evening. Remember, if you would like a copy of Chris's slide deck, you will need to email customerservice@nadex.com to request it. The recordings will be available probably sometime tomorrow on the Nadex YouTube channel. Go there, follow Nadex on YouTube, subscribe to the channel, and join us in the mornings. Please join us in the mornings, 8:45 a.m. Eastern. We do a live stream every morning. Well, except for today, we didn't do one today, but we usually do one every morning. And thank you, Chris, for coming. This was great. Loved all the tee up on the importance of volatility and how that's such a great tool when analyzing the markets. And to
Todd,
everyone else,
we'd be remiss to remind everyone, we have the boot camp coming up next week.
Oh, you know something? That is absolutely right. And if you're looking for more, I really thank you for that, Chris. Let me see if I can dig this up very, very quickly. Yep, we are doing a boot camp. Let me copy this. Next week on day trading commodities. And I've got one of our affiliates, Brian Caprice, is going to talk about event trading around oil and nat gas. I'm going to be doing a much more in-depth explanation of binary options, as well as call spreads and knockouts, if you're not familiar. And Chris is going to be in there talking specifically about trading opportunities in FX when commodity prices move. And there are some very distinct relationships there. So if you liked what Chris had to say here, by all means, and in fact, what I'd like to do, if I can figure this out, I might be able to, oh, there it is. I might be able to drop this into the link, although I think, there we go. If you'd like to register for the event, there's the registration link, but you'll also find it on the Nadex on the Nadex website under Learning Webinars. And with that, again, thank you everyone for joining us, and we want to wish you all good luck in the markets.